Welcome into the Invest Well Show. I'm your host, Michael Wall. We want to talk today on this show about pitfalls to avoid when investing in real estate. Now, listen, if you've done any research or looked at many families in America or in the country or in the world, really, for that matter, you've seen a lot of people that have literally made and grown significant wealth through real estate. And this is so important. So a lot of times people say, how can I make money? How can I grow my wealth and invest in real estate? And unfortunately, a lot of times people make emotional decisions or they take on too much what I call concentration risk when they invest in real estate. So we're going to talk about some things that you want to avoid. Listen, this is coming on the backs of years and years of being involved in real estate directly with families that we've served. If you don't know me, I've commentated nationally for media for several years. I've also been in a situation where I've had several financial companies that have helped families invest directly into quality deals. Hundreds of millions of dollars of deals that we've been involved in over the years, and really being in a place where, as we've watched those deals grow and flourish, there's a lot of things, a lot of data, a lot of research that I've taken from it that has helped people, investors, make hopefully better decisions along the way. So we want to share some of those pitfalls to avoid for you on this show today. You know, a lot of times people might say, hey, I'm going to go and I'm going to take some money and I'm going to invest into an Airbnb, or I'm going to go invest in an individual property. And I think one of the challenges when they do that is they are not necessarily a real estate investor at heart. They're kind of playing in the game. And so the tendency is to say, okay, maybe I'll do that because I think I can make money. But it's a great way sometimes where you can catch yourself in a situation that's outside of your control and it doesn't work out quite like you had thought. Maybe you spend more money for the refurb or the rehab, or you're not able to sell the property for what you thought, or you're not able to get the lease for what you had, or maybe you got lucky and you invested in some real estates where the markets were just up and you just made a lot of money and you're like, gosh, I'm really good at this. And maybe you've learned some things along the way, but you haven't necessarily experienced negative or challenging markets. So what are some of the pitfalls to avoid? I think the first pitfall that you want to avoid is really overstating your own knowledge in the space. Just because you've made money in something in the past, or just because you're new to something in the past, doesn't necessarily mean that you're going to make money in the future. Always important to understand. The other thing I think you want to think about, or a pitfall to avoid, is making sure that you're not getting over-concentrated in any one thing. What do I mean by that? Well, a lot of times you may see investors where they invest in real estate and they'll buy properties, whether it's commercial or residential or both, in a particular geographical area. And in my opinion, that's taking on what I call concentration risk. In other words, they're concentrated in a particular area and they're not diversified. We've seen kind of the reality of this in certain areas like California or Chicago or New York, where people that have owned a lot or heavy concentrations of real estate in those areas have kind of been in a place where they have gotten taken blindsided, if you will, a little bit. Why? Well, because markets change, demographic shift happens, people are moving to other areas, and now all of a sudden they have real estate that was once great, but they can't sell it. A great example is Michael Jordan's home in Chicago. It's literally been on the market, I believe, since 2012. They can't sell the house. Why? Nobody wants to move there and spend millions and millions of dollars in buying this beautiful home, even though it's being sold now for a price that's much less than what it was offered at years and years ago. So what's one great way that you can actually avoid concentration risk, be diversified in your portfolio, but yet also reduce some of your risk along the way? Well, one of the ways you can do that is by being involved in a fund. That's often the route that people will end up going, investors will go, is being involved in some sort of a fund. So I wanted to take a minute and talk about some of the pitfalls to avoid when you look at these funds and some of the differences with investing in real estate funds. I have some notes here, and this is important. You got to know the difference. Oftentimes people will invest, and they've heard of things called REITs, real estate investment trusts. Now, listen, if you're looking at a REIT, there's different types of REITs. You have publicly traded REITs, you have private REITs, and in my personal opinion, this is my personal opinion, I am not a big fan of investing in REITs as a general. Why? Well, because when you look at REITs, typically they're larger funds, and there's some challenges that come with them. One of the things, as an example, if you invest in publicly traded REITs, you're going to be in a situation where you're really not eliminating or reducing, in many ways, stock market risk. It's publicly traded. It's in essence an equity that can be bought and sold today and tomorrow. And so the challenge with that is, yes, you're diversifying. Yes, you're investing in some Wall Street firms will call it an alternative asset class, but you're still investing in real estate. But it's on market, and it's subjective to the market volatility. So in my opinion, that doesn't necessarily make a lot of sense. Private REITs, one of the challenges with those sometimes can be the fact that they are so large, $1 billion, $1.5 billion, $2 billion or more sometimes in fund size. Well, when you get in a fund that is that large, what can happen sometimes if the fund goes sideways or that sector goes sideways, it can be hard to get out, really. So what happens is your money literally is in a place where it is there and there's no exit in sight. Even though it may say it's a 3, 4, 5, 6-year fund, if things don't go as planned, your monies could be there for a long period of time. So I believe one of the better ways, not fail-proof or fail-safe way, I moved my computer out of the way there for you, a little cleaner screen. I hope you enjoyed that. If you're listening on podcast, you're like, what? Cleaner what? Cleaner who? Yeah, I'm kidding. So LPs, hey, that's a great way to get into real estate, limited partnerships. So let's talk about that. Well, limited partnerships are typically a little smaller deals. Oftentimes, they can be $20 million, $50 million, $200 million. The benefit of those, I think, in a lot of ways, can be the fact that if they are designed correctly and they are consumer-friendly, meaning that the consumer, the investor, is the one that gets the greater bite of the apple, not the developers, then you're walking down a path in a lot of ways that you can end up making more money along the way and diversify some of your risk. Now, again, when you look at smaller deals, one of the benefits to a smaller deal is it's often easier to unwind. Think of it like this. Think about trying to sell a packaged real estate fund that's got $1 billion to $1.5 billion to $2 billion. There's only a couple off-ramps as far as exiting that fund. One is going the IPO route. I'm going to IPO an initial public offering, and I'm going to go public as a publicly traded stock. There's some companies that have done that in the past, like Phillips Edison was one recently a couple years ago that invested in grocery store shopping centers that exited that route. But oftentimes, if they don't IPO, their goal is to be bought out by a larger fund. And again, the challenge is because the size is so big, it gets tough. Think of it this way. If you're coming up to the iceberg and you're in the water, would you rather be in the Titanic or a speedboat? I think we'd all realize and recognize that we'd rather be in the speedboat, right? Because it's more nimble. It's easier to move and maneuver. Similarly, with smaller deals, $30, $40, $50 million, $100 million, $2 million, $200 million deals, they're smaller and often more easily maneuverable. See if I can get that word out. But when you think about real estate as far as smaller deals, here's what I would suggest. When you look at the fund, make sure the fund is set up in such a way that it doesn't have to be sold as a whole package. In other words, if there's 4 pieces of real estate in the fund, they might be able to one-off or sell each piece of real estate as opportunity arises. What this will do is actually reduce your overall risk because now you're selling out certain pieces of the fund as opportunity arises and buyers come into the market. The other thing you'll know is your risk is actually going to be diversified because often a great fund is going to be investing in different areas or in different types of real estate. All things to be thinking about along the way. Now, another term that comes up from time to time is the idea of blind pool investing. If you've ever seen a deal where it says this is a blind pool investment, my suggestion is run. Don't do it. Why? Well, because they're raising funds to invest in real estate, and then they take those funds, which are blind pool, and then they have to then select the investment to invest in, as opposed to having preset ideas, already done the research, knowing exactly what to invest in, and then the money gets raised. In other words, you want to make sure that you don't have any stale time while your money is just sitting there waiting on the fund managers or developers to find opportunities that they feel make sense to invest in. You want to invest in a deal that already has preset, pre-researched, due diligence done on it ideas. That way, when the income and the funds and the investments come into the fund, they're ready to go. What that does is it reduces your period of time actually of being in the investment, which can oftentimes increase your potential rate of return. The other thing that you got to think about is what is the exit plan? Anytime you invest in real estate, it's about how you get out. That's really where you make the money. On the front side, when you invest monies in, You're investing in hopes and ideas that this is going to grow. On the outset, you want to be in a place where you understand how the exit is going to work. In some smaller deals, you may not realize this, but in some smaller deals, the exit on some deals are already predetermined before they start. In other words, there's already companies that are set up and ready to purchase this real estate before you get in. So how you exit really matters. Listen, real estate can be a wonderful opportunity to grow your wealth, reduce taxes, get income from real estate in certain ways where you're getting depreciating factors, if you will, and now you are not paying as much taxation on the income that you're receiving while you're holding certain parts of real estate and pieces of real estate. It can be a wonderful thing to grow your wealth, but you need to make sure that you avoid certain pitfalls and really ask the right questions about the size of the deal, what type of fund structure it is it diversified in, what type of asset class is it diversified in, is there a demand market, have they paid attention to demographic investing, meaning there's money's moving to the area we're investing in, and really how do we get out and how do we make money? How does the investor ultimately make money, and are there any safeguards along the way to ensure that we can have a higher probability of success? These are all things that are important when investing in real estate. Pay attention on the journey. Invest well. We'll talk to you next show.